Well, I mean, tools. They make themselves sound like some kind of very high class mechanic. I mean, what tools do they have? Their tools are primarily a big fat sledgehammer that smashes the value of the dollar.
SDBullion.com is a high-volume physical gold, silver, and precious metal dealer. We are committed to being your trusted source for low-cost, highest quality investment-grade bullion products. Visit SDBullion.com for more information.
Hello, welcome to another Silver Doctors exclusive. Today I'm excited to have returning guest, Mr. Michael Pento. He's an author, market analyst, as well as a money manager. Today he's joining us to share his thoughts on the economy, financial markets, and a variety of other subject matters. So Michael Pento, welcome back to Silver Doctors.
Pleasure to be on with you again, Michael.
Well, it is great to hear your voice as always, and looking forward to getting your thoughts on what's going on. And so before we dive into any in-depth topics or whatnot, I want to find out your thoughts on, we're halfway through the year 2019. What are some things that really have you, what are you really keeping an eye on these days, halfway through 2019?
Well, one of the things I'm concerned about, Michael, is the relentless valuation of stocks. So stock prices, their valuation, their market cap as a percentage of the underlying economy is back up to where it was at the height of the year 2000, right before the big NASDAQ blow up where it lost 80% of its value. And that has me concerned because when you think about what was going on in the year 2000, we had relatively low levels of debt. We had the internet productivity boom, and we had some pretty robust growth in the economy. Today, we have the same valuation, so stock market capitalization as a percent of GDP is the same level today as it was in 2000, which is 145% of the underlying economy. And yet we have really crumbling global growth, earnings growth, which is going to be probably negative for 3 quarters in a row, according to FactSet. And yet we have these outlandish stock market valuations. So I'm concerned about it. I think the hope is that, from at least the market permeables, the hope is that the Federal Reserve is going to come to the rescue and keep rates very low and lower them back to zero very quickly. And then there's the hope that all tariffs and all conflagration with other countries goes away at the G20 meeting on June 29th with between Trump and Emperor Xi Jinping. But people don't understand that, even if Trump doesn't increase the tariffs with China and they remain at 25% on the couple $100 billion in goods that currently exported from China, Trump has Vietnam in the crosshairs. Trump has European autos in the crosshairs. So, you have a slowing global economy, primarily because China can no longer inflate its bubble by issuing more debt. So that teetering debt dung pile is collapsing. Europe relies primarily on China's growth to sustain its Ponzi scheme, and a lot of the banking system in Southern Europe is cratering. And then you have the United States, which is, probably the single-celled organism with the highest IQ, but still a plethora of problems that are unresolved. And if you think that the stock market is invulnerable, you're in for a huge surprise, a huge shock, because I believe that the Fed doesn't have the bullets to save the stock market. And I also believe that the trade wars between the United States and the rest of the world aren't going to end anytime soon.
Right. Now, you hinted at with this trade war situation. Now, recently, I think it was the other day, Jerome Powell gave a speech in front of the Council of Foreign Relations, and he did a FOMC market wrap-up 2 weeks ago. And it looks like he's signaling that they're going to stick to their interest rate policy as their primary tool. So he's throwing out all types of words about their toolkit. And so do you see something happen this year where they actually utilize those tools? And is it possible for them to bring out some tools that we have not seen yet?
Well, I mean, tools. They make themselves sound like some kind of very high class mechanic. I mean, what tools do they have? Their tools are primarily a big fat sledgehammer that smashes the value of the dollar and destroys the middle class, and creates a tremendous wealth gap between the top asset holders in the country and those that have to spend a lot of their money, a high percentage of the net worth, on things like food, clothing, energy, college education, healthcare. So those people are falling further and further behind those that own lots and lots of stocks and lots and lots of bonds and many homes. So that's what their tool is. It's not like they haven't used their tool. They've used their tool repeatedly since 1987. Basically, it's legalized counterfeiting, and they systemically counterfeited themselves to a position where now the whole entire developed world has interest rates that are either at, near, very near, or at or below 0% on the overnight interbank lending rate. And it's the case in Japan and in all throughout Europe, and even here in the United States. We're 2.25% to 2.5%, which is about less than half of the average Fed funds rate. So what tools they're going to use is they're going to use the sledgehammer to crush the dollar. Of course, they're trying to engage in a currency war with the rest of the world central banks who have already crushed their currency. So maybe we're going to try to do a little catch up. I don't know how successful it's going to be. But we're going to go back to zero. Probably within the next year and a half, we'll all be at zero and below. And then the Fed's going to realize that, hey, that's not a panacea. The ECB has their overnight lending policy at negative, so their deposit rate is negative, and I don't see that engendering a robust economy in Europe. Japan has a 0% or negative deposit rate as well, and their economy is flirting with a recession, just much like much of Europe. China manipulates their currency, manipulates their interest rates, manipulates their debt structure, and their stock market is way below, about 45% below where it was in 2007. So, I mean, the faith in these central bankers to fix everything by their big, fat, ugly sledgehammer is it's eroding. It's ending, mercifully.
Yeah. Now, in your opinion, how much stimulus or what amount of stimulus will they need to or try to inject to keep this artificial expansion going?
That's a great question, Michael. I mean, I believe that we're going to go back to zero, and it might work for a while, but certainly is not a viable, sustainable, healthy prescription for an economy that's ruined, has been decimated and eviscerated by debt, low interest rates, and asset bubbles. So I do believe once they return to zero, they're going to have to deploy some of these other well-known and well-talked about strategies, such things as modern monetary theory, which is another word for helicopter money, negative nominal rates here in the United States, the destruction of physical currency, universal basic income. That depends on the fiscal policy, which also depends on who's in charge of our House and Congress and Senate and presidency at the time. But I do suspect that within the next year or a year and a half, say 18 months, we'll be back at 0% interest rates here in the United States, and then looking to some other solution as to how we can inflate asset prices, because God forbid, Michael, the rate of inflation is below 2%. I mean, for some unknown reason that I'll never understand, universally, central banks adopted this nefarious 2% inflation target, which is probably closer to 10% when you actually measure it using real world measurements like property taxes and college tuition and medical expenses, it's probably closer to 10. But the way they measure it, government measures it through something called a core PCE inflation metric, it's below 2%. And central bankers think you cannot survive. An economy cannot thrive or even exist healthfully if, God forbid, the inflation rate was only 1.5%. So they're going to use all kinds of strategies to get towards 2%, but with the further ruination of the middle class.
Right. Now, with all the monetary issues we're having, and you mentioned fiscal, and my next question was going to be the all-time highs in monthly deficit spending. And so is that going to be a trend from here on out? And then at that point, who's going to be the purchaser of our government's, of basically our debt? What do you think about that? What's the future look like for deficit spending here in the U.S.?
Well, the deficits are soaring as a percentage of GDP. They're approaching 5%. The deficit in 1 month, we set a record deficit for April of over $200 billion in 1 month. I think the deficit's running about 40% higher than it was in the prior year, fiscal year. So we're running very close to very close to $1 trillion deficits per annum. And that's going to be the case as far as the eye can see. And Michael, the problem is that this is occurring when Donald Trump assures us that this is the best economy that the United States has ever seen. And it's not a horrible economy, it's not by any means a devastating depression yet. It's also not the best economy we've ever seen. It's mildly healthy at this juncture. But what happens when the government automatic stabilizers kick in? And you get, soaring unemployment rates, soaring welfare recipients, a soaring number of initial jobless claims. So when those automatic stabilizers kicked in like they did in 2009, the deficit's going to shoot to well over $2 trillion. It went up from prior to the Great Recession, the deficit was around $300 billion per annum. It then went to $1.4 trillion. But the baseline starting off point is now going to be $1 trillion. So you add another $1.5 trillion you're going to get $2.5 trillion annual deficit. And how does that sound? That's by the way, Michael, that's over 10% of GDP. That's Banana Republic. And you ask who's going to buy it? Well, the answer is going to be the Central Bank of the United States. We're going to have the deficit of a Banana Republic, and we're going to have the central bank policies of a Banana Republic.
All right. Now, let me ask you a question. So, I'm assuming other nations, primarily those that have purchased treasuries in the past, they're aware of the trend that's ongoing and what's coming. And so, what'll happen if that is the case, where the Fed becomes a primary purchaser of bonds, to where the government runs an even greater deficit? What happens to all those other treasuries? What happened to the reserves that are sitting in vaults and bank accounts and in ledgers from other governments all around the world? What do they have to do then? What would they most likely do?
Well, China, if you're asking what China does with their currency reserves, they're going to stop buying treasuries, in my opinion. They will understand that the current number of treasuries that China holds is over $1 trillion worth of treasuries. It's not a sustainable policy. It's not a sustainable trend. Not a sustainable policy to have your reserves primarily in one currency. So they might, at the very least, completely stop accumulating U.S. Treasury debt. So that would put more and more onus of the purchases of these bonds onto the Fed, and in that case would mean that the amount of dollar dilution would have to increase dramatically, and in that case would also mean there would be much more pressure downward on the value of the U.S. dollar.
Yeah. Now, in your opinion, just as of recently, gold is getting a pretty nice bid. It's becoming more of a mainstream financial asset that people are talking about. What's the recent bid on gold going up, above the $1,400 mark? Why now? What are your thoughts on that? Why now?
Well, why now is because of the epiphany, watershed reaction from the Central Bank of the United States to go from late last year, remember in December 2018, the Fed was going to let its balance sheet runoff remain on autopilot. It'd be like watching paint dry and grass grow, run off in the background. And the Fed was threatening to raise rates to neutral, which the Fed thought was 3%, and then run about 0.5% above neutral, which would be 3.5% on the Fed funds rate, which is a full 100 basis points higher from where they are right now. And that completely shut down the credit markets, and it completely wrecked the US financial system. Shut down like it did in 2008 in 1 month, in December 2018. So the Fed changed their mind. The Fed changed their mind. They realized that they created this monster. You know, total net worth as a percentage of GDP is now 535%. That's an all-time record high, Michael. So they realized that the stock market, the housing market, and the bond market is now leading the economy. It's 5.35 times larger than the U.S. economy.
Wow.
So they realized that if the financial system were to even get a slight hiccup, it wouldn't just be confined to the canyons of Wall Street, it would bring down Main Street as well. That they created this monster, so now they have to keep Frankenstein alive by making sure we never have another recession.
Right.
I mean, good luck with that, Michael. Good luck.
Now, so it sounds like, in your opinion, is there a scenario where the dominoes begin to fall outside the U.S. and trickle their way here? Because I'm hearing about property bubbles in Australia. We got Italian banking issues. Will the dominoes fall here or start here, in your opinion?
Another great question. So, people always think, well, the U.S. started the last great recession/depression, so maybe it'll be the same thing will happen this time around. But I think that the nucleus of the crisis is going to be either in Japan, China, or Europe. And those are the biggest countries in the world outside the United States. So the U.S. is number one, perhaps tied with Europe, if you look at EU, the entire European Union economies. And then you have China right behind that, and then Japan right behind that. So the biggest countries in the world are all in some stage or phase of chaos. And in any one of those nations, the big debacle could start. I mean, a major default with Deutsche Bank, which is one of the largest banking conglomerates in the world, could bring down European banking system and the European economy. China is clinging to the cliff by its fingernails with $40 trillion of debt. That debt has quadrupled in size in the last 10 years alone. And then, of course, you have Japan, which is in a chronic state of recession, where the Bank of Japan, their balance sheet is bigger than GDP. Hong Kong is another flashpoint, which could help bring down China. So all of these issues are very, very salient. And the global economy remains one big powder keg that could blow up at any moment.
Right. Now, last question. I'd be remiss if I didn't ask you your thoughts and just looking ahead. And so with the recent activity in the gold price, and I'm assuming silver will be coming along pretty soon, is this the beginning of that revaluation in the consumer's mind frame that this is that is the asset, the actual money worth having, or will they slam it down and try to keep that keep people's attention off of metals in the days ahead as things begin to unravel all around us?
Well, one of the things that I like about gold is that it doesn't have hardly any friends. So the Wall Street community hates gold. Governments hate gold because it exposes their shenanigans. It exposes them for what they are, which I call them, legally sanctioned counterfeiters. So when current countries spend more money fiscally than can be supported by savings, they turn to the printing press, and that debauches the currency. So I believe that gold shot above 1350, which was major resistance going back years, precisely because Jerome Powell finally acquiesced and said he had to get off of this charade that he was performing to try to convince investors that he could actually raise interest rates back to somewhere close to normal. That was blown out of the water. He couldn't even get to 2.5% on the bottom rung of the Fed funds rate. That's supporting gold. Not only is that supporting gold, but the fact that the global economy is deteriorating aggressively. If you look at global PMIs, purchasing managers indexes, they are all contracting pretty quickly. Earnings growth so far for the first few companies that reported earnings in Q2, their earnings growth is down 25%. I'm not saying that's what it's going to end up, but we have profoundly negative earnings growth, year-over-year comparisons for Q2 so far. I think the whole quarter is going to be negative, and I think the same thing's repeated for Q3. So you have a spike, an incipient spike in initial jobless claims. That's starting to tick up. So all these things are this confluence of events that's supporting gold. I don't see why it wouldn't be at the beginning of its journey back towards $1,900 an ounce, and then much higher from there.
Well, Michael Pento, I appreciate you taking time this afternoon to sit down with us here at Silver Doctors. I'm sure everyone knows where to find you at, but just in case they don't, any new viewers or listeners, can you please direct them to where they can find out more about your work and keep in tune with what you have going on?
Sure. We have a website. It's called pentoport.com. My email address is mpento@pentoport.com. And the number here for the office is 732-772-9500.
Well, Mike, once again, thank you, and definitely look forward to checking back in with you in a few months, and hopefully things don't turn out to be as bad as as they sound right now. Hopefully we got some good news to talk about in the future. But thanks again, and enjoy the rest of your day.
Appreciate it. Michael.